Hi, everyone, and happy Monday afternoon. Welcome to the Real Vision Daily Briefing. I'm Andreas Steno, the senior editor at Real Vision, sending to you live the 18th of July. The economic slowdown is rather evident again if we watch the news flow of the day. Apple is planning on slowing spending and hiring growth due to the upcoming economic slowdown, basically. And that news led equities lower on the day, with Nasdaq ending almost 1% lower. To debate what lies ahead for the economy with me today, I've invited a macroeconomic superstar, in my view, to the show, Luke Roman, the founder of Forest for the Trees. Very warm welcome to the show.
Thanks for having me on, Andreas. It's great to be here.
Luke, I wanted to start today's discussion with a very fresh data print that we received today from the National Association of Home Builders. It's basically a survey designed to gauge the housing market conditions, and it dropped 12 index points. Please give us your sort of top-down view of the economy 1-2 months ahead.
Yeah, I think based on what we're hearing, we saw back in May, third week of May, the U.S. economy not just tap the brakes, but slam your face off the steering wheel, step on the brakes. And what we've been hearing in the last couple of weeks has been that the U.S. economy has hit another slamming of the brakes. And I think this National Association of Home Builder data point is simply probably at the leading edge of what is likely to be a series of pretty surprisingly negative data points in the U.S. Economy over the next 1 to 2 months.
How will this impact the Federal Reserve if we get this series of negative surprises in the real economy?
I think if we look at it in a vacuum of purely the economics, I think it pulls forward the day where they pause interest rate hikes. I would expect them to say something along the lines of, we're going to become more data dependent or something. And I still think ultimately that that will take place. That pause, the last Fed hike, will take place by the end of August of this year. With that said, that's in a vacuum. The wild card in all of this is the geopolitics, which is that given what has happened with Russia invading Ukraine and the tensions around that, to the extent that the dollar sanctions that the U.S. has put on Russia have largely not worked the way they had hoped, certainly not to the severity they had hoped, then the wild card in all of this is that the United States realizes that Russia's hand is stronger than they thought, and the U.S. is basically the Fed has become a policy arm of Treasury, and that they are running effectively a playbook seen at the end of the movie in Platoon, where the base is overrun by enemy soldiers, and they call in an airstrike on top of themselves, hoping to basically kill as many of the enemy soldiers while acknowledging that they're probably going to kill a lot of their own soldiers too. And so I think there is a non-zero chance. I thought it was a really tiny percentage chance 3, 4, or 5 months ago. Over the last couple of months, given the headlines we're seeing around the tensions, around the potential energy crisis, et cetera, I still think it's a minority chance, but I think there's a real chance that the Fed has been weaponized by Treasury, and despite this sharp slowdown in the U.S. economy, they go ahead with tightening. And if they do that, you're going to want to own dollars, and that's about it. Everything else, I think, will fall in that environment. And then from there, things get really hairy in the economy, in the politics. I'd be surprised if they do that a couple months ahead of a midterm election. Like I said, I still think it's a tail risk. But ultimately, my base case is that what we're likely to see, in my view, in the U.S. economic data over the next month or two is likely to pull forward the day consensus of where the Fed is forced to pause hikes.
If we look at the current market pricing of the Federal Reserve, we can take the euro-dollar futures curve as the example of that. The market at least tends to agree that the pivot or the pause is upcoming within, say, the next 6 to 7 months. What would be the trigger for an even earlier pivot than that?
I think it has to be a problem somewhere in the Treasury market. You've been seeing auctions get sloppier and sloppier. You've been seeing volatility in the Treasury market get higher and higher. A few weeks back, you saw for a span of time, a few Fridays back, you saw the mortgage-backed market in the United States go no bid for a little bit, which is not very conducive to U.S. economic growth. So I ultimately think it's going to have to be some problem in the Treasury market. And for me, when you define what that could be as extreme as something that we saw at the short end with the repo rate spike in September 2019. It could be as subtle as what we've seen numerous times since, maybe most pronounced in March 2020, where you saw the Treasury market begin crashing alongside stocks, rising yields into a recession. Again, is very non-conducive to, forget the U.S. economy, it's very non-conducive to the U.S. government's funding status. So that, to me, I think it has to be something around the Treasury market that forces the Fed to pause. You could also maybe get some good news on energy. I think a window on that may have passed with Biden having been in Saudi last week and oil having already been off the highs, but we'll see. But I think the real big thing to watch is Treasury market, and in particular dysfunction in the Treasury market.
If you ask me, we already see signs of liquidity stress emerging in the bond markets. Take, for example, the amount of fails to deliver in the repo space. It's rising week after week. Would that be one of the gauges that you would follow over the coming months in terms of gauging the liquidity stress in markets?
I think it would be probably one of a number of them in trying to put together the mosaic. There's no, I would say, one thing, but yeah, I'm looking at that. I'm looking at what has happened to FX hedged Treasury yields as a big one. I think when you look at the FX hedged yields of U.S. Treasuries for European investors, they're all-time lows. Yen, they're near all-time lows. They are negative, which means as you see, you are paying foreign investors not to buy Treasuries at this point on an FX hedged basis. And so when we've seen these types of negative numbers in the past, it has generally stress in credit markets have generally followed pretty quickly. Fed pivots have generally followed pretty quickly. We're already there. So a big part of that, of course, in terms of driving that is the strength of the dollar. And so the dollar is already strong enough to create some very severe, to create increasingly severe, I should say, stresses in the credit markets and Treasury markets specifically. So I think it's coming to a head rapidly, and that's ultimately the basis for why I think the Fed's going to be forced to pivot by the end of August.
One thing is the Fed outlook, but the fiscal policymakers can obviously also try and tackle the current situation via, for example, austerity measures. You recently made the case, Luke, that policymakers are sort of deluding themselves that austerity is still an option. What do you mean by that? Please unpack it.
Sure. So when you look back throughout history, Carmen Reinhart and Ken Rogoff did a piece, a research report, a book, 10 or 11 years ago, I guess now, and the title of the report is "It's Different This Time." And it went back through, I want to say, 500 years of sovereign debt crises. And somebody whose work I read every time I can get my hands on is a gentleman named Brian Hirschman and Hirschman Capital. And I've looked at their data. He's unpacked it a different way, but the gist of it is if you look back over the last 120 years, 98% of sovereigns that had debt to GDP go to 130% ended up defaulting on their sovereign debt. Now, default happens one of three ways. You can go austerity, you can go restructuring, or you can go a span of high inflation to basically inflate debt to GDP back down to sustainable levels. Almost all of them work this default via inflation, simply because you're a sovereign, you can print money. That's usually how it works out. And so the United States is, number one, obviously in our business, 98% shots over 120 years, they don't come around very much in the investing business. Furthermore, Hirschman has pointed out that if you look at the debt, nations since 1991, over 110% of GDP, and deficits to GDP of 11% or more, there have been 18 nations in 30 years that have had that happen. 100% of the 18 nations defaulted on their debt, usually via high inflation. So the point here is that the United States went above 130% in 2020. The United States remains above the 110% threshold in the second case, and U.S. deficits have already exceeded the 12% or the 11% threshold last year. Obviously, that was coming off the COVID crisis. So I think between that and reserve status for the U.S., there's a bit of a respite. However, if policymakers put the U.S. into recession via austerity, it's basically a layup that deficits as a percent of GDP, which are currently around 6 to 7%, the highest they've ever been to start a Fed tightening cycle, by the way. It's a layup for them to get to 10 to 11% of GDP in just a modest recession, let alone a severe crisis. And so the U.S. at that point would be satisfying those two conditions. Now, and I failed to mention, 18 out of 18 countries that satisfy those conditions over the last 30 years defaulted on their debt within 2 years. And so now, is the U.S. going to default on treasuries? No. Is the Fed, to me, what that tells me is that these conditions have really already been satisfied. The the Fed's going to have to return to effectively monetizing U.S. deficits. Because austerity when the U.S. government is 22% of GDP is simply not a politically palatable policy option. It's not an economically palatable policy option, because when you're 22% of GDP and you cut spending 20%, like Janet Yellen just did in the last couple of months, what you end up doing is you get GDP down. And when you get GDP down, when debt to GDP is still 125%, like it is in the United States, what you get is a debt death spiral, where you get GDP down. As long as your interest rates are above, since you can't take your nominal rates negative as the reserve currency issuer, debt goes up and up, GDP goes down. So ultimately, sooner or later, and again, within 2 years, the Fed's got to come back and start remonetizing. So that's ultimately, when you look at the breakdown of the history of where the U.S. hit, of the structural nature of these deficits. I mean, you're looking at 115% of tax receipts are Treasury spending, entitlements, and defense alone, let alone everything else the U.S. government spends money on. So there are things we can't cut, and then we can print the money. So I think ultimately, this view that quickly became consensus, that Powell can be another Volcker. And run can tighten policy, and Yellen can implement austerity at the fiscal level. It's a delusion. It's not going to happen. And I think we are in the very early stages when you talk about the home builder survey, when you talk about what Apple's saying, when you're talking about what the U.S. GDP did in the first half of the year. We're in the very early stages of this being proven to be a delusion, that austerity, the ability to do austerity in the U.S. is a complete delusion.
I hosted the UK economist Frances Coppola last week on this show, and she basically forecasts a new era of very easy fiscal policy paired with tighter monetary policy. Do you think that mix can work to solve the current situation?
That's the old Druckenmiller playbook, right? A lot of fiscal stimulus and tight, loose fiscal, tight monetary, and it's really good for your currency. And it worked, in Soros's book, or excuse me, in the book Market Wizards by Jack Schwager. Druckenmiller talked about how when the Germans did that after reunification, it was great for the Deutschmark in the 90s, and the U.S. did it in the early 80s. It was great for the dollar. Do I think they can do it again? No. And the reason I think they can't do it again is what we just described is going to be really good for the currency. If the dollar strengthens, which would happen if you did that, what Coppola said, we're already seeing that there isn't sufficient demand for treasuries to avoid dysfunction in the treasury market with the dollar where it is today. So you talk about taking the dollar even higher, you're going to be sending FX hedge treasury yields even lower. And so basically you would see a nonlinear increase in deficits that would likely send interest rates higher. And again, when the U.S. ran this in '82, debt to GDP was 30%. The Germans have always been much more fiscally restrained, certainly back then than today. We're not starting from a position that we can run this given where the dollar is. You strengthen the dollar from here with that playbook, that Soros, Druckenmiller, strong dollar playbook, which is deficits up, rates up. You're going to create problems in the global economy around dollar funding, and the global economy is the majority of global GDP, right? Starting in 2014, emerging markets were the majority of global GDP for the first time in 350 years, right? So you can sort of take every playbook, every model that a lot of economists run prior to 2014, you can throw them in the trash because we've never seen anything like this. The first time in history that emerging markets are the majority of global energy demand post 2014 or 2015. Again, take all the pre 14, 15 models and throw them in trash because you have to modify them or else you're going to come to the wrong conclusion, like what the Fed's doing right now, in my opinion.
If we look at the recent signals sent by the Federal Reserve, for example, from Waller, from the committee, he's been very vocal that the Federal Reserve intends to bring inflation-adjusted interest rates back into positive territory across the yield curve. Do you think that's even a possible scenario over the next couple of quarters?
Sure, if they want to create a bigger crisis than 2008, yeah, they could do it. It's so interesting to me, right? These guys, they fly to sound. They're such political animals. I mean, you go back to November of 2020, Larry Summers and Jason Furman, who was an economic advisor to the to the Obama administration, knows the Biden administration. These guys put out a paper pointing out that it was critical to keep a little r below big G, right? So it's critical to keep nominal rates, interest rates below nominal growth. And you're still there for the moment, but if you take real rates positive, you won't be there for very long. And so they're literally advocating a policy that they said would bankrupt the government and break the system 2 years ago, not even 18 months ago, because the polls stink because of inflation, which was the policy they were advocating. So they actually succeeded what they wanted to do. They actually got the dynamic that they need to get the fiscal situation of the United States to a sustainable situation, which is we saw in 2021, 129% debt to GDP fell to 122%. So we delevered debt to GDP by 7 percentage points. It took 11% nominal GDP and 8% CPI. Listen, that's what you needed to do. If you didn't want to do that, you should have been an adult and actually implemented austerity 30 years ago, 20 years ago, 10 years ago, but you weren't. You were children and you simply didn't, you weren't leaders. And so the failure of leadership on both sides of the aisle in the United States and in other Western social democracies means this is what you have to do. You have to inflate it away. So, but now the polls are saying people are mad about inflation. And so you're going the other way. So to me, yeah, I saw you said that. I think it's a bad idea. If they do it, sure, you're going to have a tremendous crisis. We're going to see the housing, we'll talk again in 2 months, and that housing index will go from 67 to 55 to 45 to 30, obviously well into recessionary levels. And then they'll all be freaking out. Oh, gosh, why are Treasury auctions going so badly? And why are yields going up in a recession? And this is the worst crisis ever. And the balance sheet's going to be 20 trillion in 2023. And so sorry, I'll get you. You've got me a little worked up now. I just think there's such politicians flying to sound, and I think it's not very helpful to, it's like being on a plane of which we're all riding on, knowing the pilot isn't flying by looking out the front window. He's looking at the ground as he's flying by. And it's fine, if you're here in the United States, you take off from New York and you fly west, and you can fly the plane like that for like 3 hours. It's great. Pilot's looking out the window, and then you hit the Rocky Mountains, and your flight ends really abruptly and very painfully. And that's what they're doing. It's just, I think it's a bad idea, but maybe that's why I'm not on the Fed.
In a year from now, will we be debating quantitative easing and negative real interest rates again?
Oh, I think we'll be beyond debating a year from now. I think it'll already be done. I think they'll be back to it.
Yeah. I tend to agree. Let's shift gears a bit and move to the other side of the pond because we got interesting news from the Russian gas company Gazprom today. They've apparently sent so-called force majeure letters to 3 clients relating to the lack of gas flow to Europe. First of all, what do you make of that game of chicken between Russia and Europe right now in terms of the gas supply?
I think Putin holds almost all the cards, whether people like that or not. That's increasingly looking to be the facts of the matter. He has the gas and he's got the better balance sheet. I think if I was playing his hand and I wanted to make my point, and I wanted to do so in a way that hurt as few women and children, so to speak, and old people as possible, I would shut it off now. And I would let them feel what hot temperatures feel like, and I would let them know that I meant business and that they better get their stuff in order and start paying me how I want to be paid, and they better, what all the other issues going on around this, because I do think it's a very complex, not black and white, very shades of gray matter. That's when I would do it. Versus, I think doing it in December, doing it in November, doing it in January, you're going to make yourself the bad guy. And he's already the bad guy, but you're going to create an unnecessary humanitarian disaster among innocents. And I like I said, if I was in his shoes, quite frankly, I think it's maybe a sign of goodwill, a little bit of like, listen, we're just going to shut it off now, and we'll let you guys see how you like summer without it. And you come back and call me when you're serious.
I want to play a soundbite for you in relation to this debate. It's from an interview I did with Swiss-German Alexander Stahel, a solid commodity expert, on this exact topic of the Russian gas supply. And he's pretty convinced that they will never re-allow the gas supply to flow again after the maintenance of Nord Stream 1. So let's listen to the soundbite and get back to the discussion.
The Europeans need it while they can, but for sure now, they're going to do everything to diversify away from it, and they're not going to get back to the Russian experiment. In fact, I would argue this will be the only time in 100 years where we're going to go through that experiment and something better will come out of it. Now, first we have to feel the pain for the next couple of years, but at some point something better will stand there, and then we're all glad we don't have to deal with that Russian flow. And you're absolutely spot on. They cannot just redirect those gas flows into Asia. It needs pipelines, but I think they're going to start to build those and try to redirect as much as they can, but they will have revenue losses. And I think Putin says, look, I have maximum pain from the EU on my sanctions, and they do. Everyone else who says something else and thinks the Russian economy is not contracting and not hurting hard is diluting themselves. I mean, it's bad over there, for sure. And so probably Putin's way, who only knows escalation, the mafia boss, says, okay, so let me inflict maximum pain on Europe too, and that's best done by cutting off the gas now. And then he still gets plenty of revenues from the the oil situation he has, where his 5.5 million exports of oil still flow uninterrupted.
The full interview with Alexander Stahel is available for subscribers on the Real Vision platform from today. Look, I think Alexander is spot on in his analysis of Vladimir Putin. If the gas flow stops and it doesn't return, say in August, September, would that be enough to send the global economy into recession, you think?
Absolutely. I think I think it'll be catastrophic. I go back to early in my career in the late 90s, Southeast Asian crisis. You saw the currency crisis over there. I remember sitting in morning research meetings where analyst after analyst would tell us, don't worry, Asia Pac is only 5% of revenues. It's only 10% of revenues. It's not going to matter. And yet, 9 months later, the U.S. industrial economy was in a recession. 12 months later, 10 months later, the global monetary system, global financial system almost collapsed through the long-term capital management link after the Russian default. So it's all about what happens on the margin. It's all about the inherent leverage in the system. And so on the margin, Europe, Japan, these are orders of magnitude more important regions than what Southeast Asia was to the global economy. You'd be talking about, and this is something we've been writing about for 4 months now. It's something I've tweeted about a number of times. Europe is effectively running the same economic playbook vis-a-vis Russia and the gas situation as Weimar Germany did in the aftermath of World War I, after the French seized Ruhr Valley coal stores, which is take away some of the energy supplies and then print over money to try to maintain the nominal economic, some nominal economic illusion. What you end up doing is hyperinflating. And you're seeing Europe start moving toward hyperinflating. When you're seeing German PPI up 30%, and now you're talking about unlimited ECB programs to prevent spreads from blowing out, and it's hilarious to hear them talk about, oh, well, we want spreads to reflect economic reality. They are reflecting economic reality. You're going to default. Like they're going to go broke. You're going to have people in the cold. So you're printing money over a loss of energy inputs. You'll be talking about a collapse of the euro. The euro will, parity. It's going to go a lot lower. Now, where it starts to get really interesting, and I'm still not seeing a lot of people talk about the second derivative of this, which is if there's not enough gas, if there's not enough energy, European supply chains are going to break down. When they break down, you're going to have supply chains everywhere around the world break down again. When that happens, global CPI is going to go up again. And we can take every 10-year yield chart of every government around the world, and we can draw a line on those charts, rough estimates, right, at top and a bottom. We can all guess where they are. Where once yields hit that point, the government's going to go broke mathematically. They're going to default. They're going to go into a debt spiral. It's lowest for the Japanese. It's probably marginally higher for the Americans, or higher for the Americans, higher maybe right around the same for the Europeans. The point is that those lines on those charts, once that second wave of inflation hits from the global supply chain breakdown that will happen if the Europeans have to shut down their production facilities, because again, these supply chains are so intricate. Europe makes so much. You take out their supplies, supply chains are going to collapse again, just like they were a year ago now. And when that happens, we know what happens to CPI now. It goes up 600 basis points, 500 basis points. So now you'd be talking about, let's say we bring it down a couple points. We just printed 9, maybe it goes to 7. Now we take it up another 5 to 6. Now we're running 12 to 13% CPI. Is there a government in the world that can afford 4, let alone 10? No. Putin can. He's got the best balance sheet. He could absolutely afford it. He could sell his gold, pay it all down, buy off all his foreign debt. So he's, I think, leveraging basically his gas position, but also it's a balance sheet contest, and he has by far the best balance sheet versus his opponent. So if this gets to that point where August, September, they shut the gas, it is hard to overstate. This will make the great financial crisis look like a tea party. It is that big a deal, in my opinion.
I ultimately also wanted to pick your brain on the repercussions for the reserve status of the dollar as a consequence of this ongoing crisis with Russia. We know that both Russia and China have taken firm action over the past couple of quarters. So please unpack for us what's going on in the reserve space, so to speak.
I think ultimately we are in the midst of a transition that began probably shortly after the aftermath of the great financial crisis, when it became apparent to Russia, China, and others that the U.S. had ceased and would forevermore cease to manage the dollar as a utility for the world. And basically, when push came to shove, the Americans would print money. Which, if you're either an energy exporter like Russia, or if you are an creditor to the Americans that imports energy, like the Chinese, like the Japanese, like the Europeans, if the Americans were only going to print the money, you have to move to a system where you gain the ability for these importing nations to buy energy in your own currency. Because if you can do that, you can avoid a balance of payments crisis like Europe is facing now. The fix to what Europe is facing is, and I think where this is ultimately going to go, is Europeans are going to go, sorry, America, we have babies freezing in the dark. We need to buy energy in euros from Russia. Russia has agreed to that, and we're moving on. We're gonna buy energy in euros. The problem with this is you then need to find some asset to settle in. And I continue to think that settlement asset is going to be gold, at least in the interim, at a floating rate. The Europeans floated this proposal out. You can go back to U.S. State Department archives in the 70s when Kissinger was very involved in the U.S. administration. The Europeans were looking to settle energy deficits with the Arab oil exporters in gold at a floating rate. They were going to mark gold up and do that. So this has been something that's been discussed. People say, "Oh, reserve currency changes take 50 years." This has been discussed for 50 years. And now, but the problem is always with humans and politics and long cycles, is it takes a long time, and it takes a crisis, and it takes a severe crisis. And what do we have? We have a severe crisis. The Europeans, the Japanese, are going to be forced to choose. Do they want to buy energy in their own currency, or do they want to freeze? And that's where this is coming to. So I think we're coming up to a potentially very interesting period in time where we could see some very binary shifts in the global geopolitical ordering, the monetary system, the reserve. Now, is the dollar still going to be reserve currency? Yeah, I think it will be. Will the Treasury still be the primary reserve asset? No, I think it'll be gold. When this happens, I think gold will be orders of magnitude higher. So I think you're really talking. People always ask me, what's going to replace the dollar? Nothing's going to replace the dollar. We're going from a system where the dollar is the global reserve currency, Treasury bond is primary reserve asset, to a system where the U.S. buys energy in dollars, the Europeans buy it in euros, the Japanese buy it in yen, the Chinese buy it in yuan, the Indians buy it in rupee, and then you net out any deficits with the energy and commodity suppliers, and whatever's net left over gets settled in gold, one way or another, at a floating rate in each currency. That's what I think the system is moving toward. And there are people that are interested in seeing that happen. There are people that are not interested in seeing that happen. I think some of the geopolitical tensions we're seeing around the world are tied to this shift, and people in favor of and against this shift pushing back and forth at each other.
We have time for a couple of questions from the audience, Luke, and we have a great question from someone at the Real Vision side. What happens, in your opinion, if the Fed pauses and inflation stays above 4%?
I think ultimately it pushes them towards some version of yield curve control. Remember, austerity is going to send a death spiral, basically. They really are stuck between a rock and a hard place. So what I think it does is, in the short run, it probably will push inflation back above 4. This is a problem familiar to places like Argentina, Turkey, et cetera, these twin deficit nations with these balance of payments problems, high levels of debt. I think you'll see jawboning from the Fed again that, hey, it's transitory. They probably won't use that word again because it will trigger PTSD with various Fed people. But I think they'll try to jawbone that it's not as high as it is. But ultimately, I think it pushes the Fed into some version of yield curve control for a period of time, where the Fed says, look, the 3-month Treasury is 2%, 3%. The 10 years 4, and that's it. And we'll buy at those prices. And people keep saying, "Oh, we're Japan. The U.S. is Japan." Well, this is Japan. The difference is the U.S. runs deficits. Japan didn't run current account deficits. We do. So it's going to be inflationary. The U.S. being Japan is going to feel a lot like the U.S. being Argentina with U.S. characteristics. And again, is this how I want it to go? No. But again, we had 40 years for our political leaders to be adults, and they weren't on both sides of the aisle. And so this is what you get.
I've made it my trademark, Luke, to conclude the daily briefing with a meme. And today's meme is basically one for the friends enthusiasts out there. The bond market is telling the Fed to pivot as loud as Ross yells at Rachel to pivot the couch in the Friends episode. And if you're right, Luke, then I guess the pivot is almost around the corner. It will certainly be very interesting to follow that. Luke Groman, the founder of Forest for the Trees, it was a pleasure to interview you. Thank you for joining the show.
Thanks for having me on. It was great talking with you, Andreas. I enjoyed it.
This concludes the daily briefing for today. My colleague Ash Bennington will be back tomorrow. So see you there. Thank you.